I'm not going to really go into my backgrounds since Allison just gave such a warm intro. And I think one thing I will point out is that in my heart of hearts, I come from a product background. So I actually love diving in deep, trying to understand the product, how it works when I'm getting to meet with entrepreneurs. And I've also been fortunate to really get to work closely with a lot of the entrepreneurs, high growth companies in Pittsburgh over the last 15 years or so. And I think hopefully there's some names on here that you recognize. So a little bit more about InnovationWorks. I got a couple slides there just to give you an overview. We invest across the three key technology sectors. Software, and as you can see here, I've also delineated some of the subsectors, as we call it, or the segments within software to show what we mean. Life sciences and healthcare, and also hardware, robotics, physical products. So I think that's another way of saying we really do invest across the full technology realm. And so I'm going to try to make this presentation as applicable to each of these sectors as possible. So at InnovationWorks, really a key differentiator for us is that we help companies get to the next stage, and we have funds and programs really aimed at the different stages that a company is in. So we have our accelerator programs that really provide a lot of structured urgency to help companies get validation, to help them build their networks, and to really position them for that pre-seed seed round. And we have a seed fund that can also participate in those rounds. And we also have a growth fund, Riverfront Ventures, that allows us to invest alongside institutional investors as they invest in our companies. An important thing to also point out is that we really offer an underlying platform, community, networks, and expertise. So we know that capital is important for companies, but it's not sufficient. And it's important to surround them with fellow entrepreneurs, to offer support, and really learning from each other. One thing we've learned from working with so many companies is just that value of having entrepreneurs helping each other. Building networks. As you'll see from the next slide, we do have a sizable network of mentors, investors, corporate partners. Again, we really work to bring all of those to value for entrepreneurs. In fact, one of my colleagues, Peter, is on the Zoom call, and I know he works actively to build relationships with investors across the countries, and so that we have more connections to offer entrepreneurs. And then finally, the expertise, whether it's individually given or through programs and content. And again, focus on the key areas that we know that entrepreneurs and startup companies are focused on, right? How do I build the right product? How do I manufacture it if you're a hardware company? Definitely sales and marketing, a lot of emphasis on digital marketing, customer acquisition. We know that investors are really going to focus on that, how you're going to have a repeatable customer process, and we want to help companies with that. Talent, not only how do you build a culture, set up the processes, how do you embody DE&I best practices in the beginning, because it's really important for startups today to be able to have that foundation in place to grow. Startups that don't have that in place are going to have a harder time scaling and growing because they're not going to attract talent, because more and more folks want to work in a company that supports those values. And then finally, fundraising, really, and hopefully this presentation will give you an overview of how we think about fundraising, but also we do a lot to work with companies specifically for their company, their industry, and their stage. And then in terms of InnovationWorks, our track record. So we have been doing this since 1999 in the seed fund model. You can see here, 110 million invested, over 500 companies. We're nationally ranked from PitchBook in terms of investment activity. Our accelerators have been nationally ranked. But really what's significant, or what I want to pull from that, is that means that our team, the folks there, and plus the institutional history, we've seen a lot of deals. We've seen a lot of the deals. We saw the pitches of the entrepreneurs coming in. We are talking with the investors, getting their feedback, and we're really formulating our thoughts on kind of, hey, what does the market look like? What are the terms that companies are getting? How realistic is it that you can raise this round that you're trying to raise? What type of traction do you need? And so really we're bringing all of that information, that knowledge, to help entrepreneurs as they're formulating their fundraising strategies. Because a lot of times fundraising strategies can also go bad, not because there's anything wrong with the company, but maybe your expectations were off or out of line with the market, and that you don't get any traction initially because either your expectations of how much you can raise or your valuation is out of whack with the market. So I wanted to kind of give that overview about IW. So in terms of this pitch, why do I call it beyond the pitch? I think originally I was asked to talk about the pitch deck and how do entrepreneurs improve that? And I will talk about that, but really I'd like to give everyone more insight into how investors are really looking at your company. And we'll go through the set of slides as the framework for doing so, but it's really hopefully giving you a little bit more insight to the things that investors think about, so it helps you as you're putting together not only your investment communications, but really just overall your fundraising strategy. I think some caveats actually is that this particular presentation is not about the specific strategy, how much should you raise, from whom, is this the right time, nor is it about the process. What's the way to run a process so you can, efficiently contact, 100 entrepreneurs or get the intros that you need to be able to, close around. For those of you on VC Twitter, you probably see the entrepreneurs talk about, hey, I raised a $10 million round in 1 month, and here's how I did it. So it's not about that. Although I know First Round Review has some great case studies on that. I think another caveat, this is on early stage presentation. So it's pre-seed, seed, where the financial model, the revenue model, the customer acquisition strategy, all of those are not baked in yet. The company does not have enough of a history where investors should be looking at how did you do month over month in terms of hitting your projections. Although that is going to be more and more important as you raise larger rounds or later rounds. This is not aimed at, if you're doing pitch competitions, I think my first advice is definitely follow the guidelines or the rubrics that competition gives you. Maybe you can pull some of these things into that, but I wouldn't do that. And the last point I really want to highlight is this is not your customer sales pitch. That, in fact, one mistake I see often are companies that kind of start with the fundraising deck and then turn that into their pitch deck. And then I would say, start with two different bases and build from grounds up. I think one example was when you're pitching to an investor, often you're trying to show, hey, we're a new company, we just got started. Look at all this progress we've made in 6 months or 1 year. Well, if you start with those type of slides in your customer deck, immediately you're telling this customer, I'm a new company, I just got started, and the customer's thinking like, I don't know if you're going to be around. So I mean, I just use that to really illustrate that point. So in terms of frameworks, I'm probably one of those folks that is not very formulaic. I don't sit there and say, you must have these slides, whatever, but there are things out there. There's Guy Kawasaki, the 10-20-30 rule. These are the bullets that he suggests. And actually the 10-20-30 means 10 slides, 20 minutes, 30-point font. So he's a great presenter. He was heavily involved in the launch of Apple and has been sort of known as the Silicon Valley marketing guru. But also kind of just balance it with East Coast. Next View Ventures, they're probably not as well known. They're a seed fund based out of Boston, but they put out a lot of insightful content. So I'd recommend you take a look at them. And Rob Go kind of put out his framework for what he wants to see in a fundraising deck. And he's kind of outlined probably the slides, the order. And I think at the end of the day, a lot of these decks are all around the same thing, but maybe every investor has different points of emphasis. And I'm going to get into that with sort of my framework, and I'm definitely sort of putting it in quotations. So And I think the thing with the framework here is the word and. So the word and is critical because, you know, when you're meeting with an investor, you need to convey that big vision, that big market opportunity, and the detailed evidence that you're the company that's going to win it. And often I've had entrepreneurs frustrated. They say to me, it's like, you know what, I pitched this big vision, and then the investor said, you know, they didn't really see how we were going to execute, and they wanted to see more detail in execution. And then they said, hey, so then I kind of did a very detailed execution slide, and then they say they didn't see the big picture vision. So it's really important to show, and of course, this is easier said than done, but showing that balance of the two. Now, I'm going to go through these remaining, oh, I'm sorry, I didn't do the slide build. And the evidence would be, these 8 bullets or so. Those are sort of the way I've summarized those things that you saw on Guy Kawasaki or Rob Go's slide. And I'm going to kind of go through each of those and try to give a little bit more detail. So first is the compelling market opportunity and vision. And I think of this as the narrative as well. This is the key to the pitch. What is it? It's not just, hey, here's a big market. Let me show you some industry stats of the size and growth, although that is helpful. But it's, as an entrepreneur, as a founding team, what is your unique point of view? What's your big vision on this market? And often when we're listening for pitches, I'm actually listening for a little bit of dissonance, meaning I'm listening for maybe something I haven't heard before, or I'm hearing a story around, the classic one, right? Big market, kind of stagnant, the incumbents in the industry have sort of gotten soft, or there's a new regulation coming in. So in some ways, the narrative is no different than, say, plot lines in a movie. I mean, I've been watching a lot of Netflix, I think, during the pandemic, and my daughter's really big in the musical theater. So we're always sitting there talking about plot lines, and she always boils everything down. She goes, Dad, there's pretty much only so many tropes in musical theater. And I'm not even sure I know what the word tropes mean, but I think it's the same analogy here with narratives, that there are only, there are certain ones, right? It's the emerging market based off new technology that's, kind of growing quickly. So the overall market size is not that big, but it's growing fast. Or it's the large, stale, stodgy industry, or sometimes it's or it can be technology-led or regulation. So those are some of the ones. And then I think the thing about why it has to be big, is just that, I won't go into it here, but often, especially with VCs, the whole VC model, for their economics to work, they need each company that they invest in to potentially be able to return, outsized returns. Sometimes you hear it referred to as power laws, $1 billion plus opportunities or exits, because they're looking at a portfolio of 10 to 15 investments in their fund, they are assigning probabilities that some are gonna not return any money. A bunch in the middle are going to return, 1x to 3x or whatever. And then, so they're counting on those, 2 or 3, winners that are going to, deliver, outrageous returns, minimum 10x or, 100x. So that's a lot of reasons. And from an institutional investor standpoint, they only have so many investments they can make in a fund. So they may really like a company and believe in the founders and believe that this company is going to be successful, yet they may feel like it's not big enough to meet their investment hurdles. So that's one of the dynamics. So back to this slide around, I'm going to go through the evidence and these bullet points. And I'm going to go through them one by one, but I want to try a new analogy. So I'm going to debut a new analogy here. Never done this. Think about these. These are hat racks. And so you can see the one on the left, there's about 4 racks. And then the one on the right is, 15 of them. And I think the analogy to think about is, if you think about all of those slides and all of those points you're trying to make, you're not trying to land every slide or every hat, if you think of each slide as a hat, on the rack on the right, because that's hard to do. What you're really hoping to do is land 2 or 3 or maybe up to 4 on the one on the left. And so that means you've got to think about what are the key points about your company and your current stage that you want to get across to investors and that you hope it lands. Because often from the investor side, we're looking at, when we debrief and discuss a company, we usually do summarize it in 2 or 3 key themes or the investment thesis, so it's not like we sit there and talk through all 8 or 10. It's sort of, what's the couple of 2 or 3 things that are the highlights that we would focus on if we were having a informal conversation with our colleagues about this company we just saw. So anyway, testing out that analogy here. So now going into the specifics of each of the areas. I think first, team. This is a lot of investors say, we're looking for team, we're looking for team. And, I want to kind of push everyone to think, I think everyone on this call is at a high level, high caliber. So therefore, at some level, and the folks at CMU, clearly investors are going to kind of see that. But really, I think they're looking for even more, the unique qualifications, founder market fit. Do you come from an industry? Do you have unique insight into this market problem? Or do you have the connections or experience to really execute upon it? Now, if you don't necessarily have that, then a lot of times that's why you do have to show, what you've done to date in traction. Team chemistry is really important, especially if multiple founders in a pitch. You don't want this CEO just to dominate and the other founders basically have no role, but yet as founders or team members, you can't be talking over each other because that also will raise a red flag. I know of a company many years ago that really lost a VC deal. They signed a term sheet, and as part of due diligence, the VCs picked up on this dynamic where they didn't think all the team members were on the same page. So they asked for one-on-one meetings with each management team member. And then at the end of that process, they're not on the same page and walked away from the deal. And then I think the final point around coachability, that's another hard one. I know for founders, you hear that a lot. It's like, what does that mean? It does not mean that you automatically say yes or just are agreeable to what investors suggest. And honestly, if an investor wants that, they're probably not the right investor for you. I think what they just want is to be able to have a good, thoughtful dialogue, discussion about the assumptions that you have in your company, if you're going through your financial model, and that it's a very good exchange, because that's really a proxy for what the relationship would be like post-investment. So I think that's really what they're talking about with coachability. In terms of the understanding of customer problems, again, here it's I think the theme you're going to hear from this talk is, right, it's kind of helping everyone kind of push to that next level. So there's the sort of table stakes of what you need to show, but then, how do you kind of show that level that gets you to the investment? So I think in terms of understanding customer problems, yes, you need to clearly identify the market, what the customer problem is, but do you really know it at that detailed level? And especially, do you kind of, from the investor standpoint, we're like, am I learning from this presentation? Am I learning something about this market I didn't know before? And we expect to learn. We don't expect to know more about the market, than the entrepreneur. And then the importance of segmentation. I mean, it's a little bit more nuanced, but when you can start breaking down your market into the segments and start telling me like, well, we're going after this segment first rather than that segment because this segment really values this, and this is where we're best positioned now. Eventually, our roadmap's going to get us to tackle the next segment. That's really important. And then a final point here is that the better you can define that target customer to a segment level, it also helps you when you start thinking about reaching customers and how do you sell to them. Asking your mentors for intros, right? I think the analogy I've used before in the past is if you tell them that you're looking for introductions to a consumer company, as someone on the receiving end, that I'm not quite sure how to help you, but if you can get very specific. So, honestly, we are tackling D2C. We're tackling D2C in the, sporting goods segment. We're talking to someone who really has experience with either industry and sporting goods or D2C experience, or especially the merchandising side. Now it starts getting me thinking about, do I know someone that can help you? And then finally, how intense a problem this is. I'm going to talk about this more in the next slide, but again, it's acknowledged that there's a problem, but then there's the question like, how intense is this problem? Is it enough of a problem. And so that's really kind of the next slide, talk about the product enough value. It's, does it solve enough of a problem where the customer is going to change what they're doing, put you into the budget, or even just adopt the resources and the mind share to want to implement what you're doing. And I think you can apply that to consumer realms as well, but definitely, in the B2B enterprise setting, those are things to think about. Often investors are going to ask you about IP. Hey, do you have patents on it? And I think if you're especially a software services company, often that you may have decided that patent isn't the right strategy, that you're going to use trade secrets and other ways of protecting. And often what they're asking you for is actually, how do I know that someone isn't going to just copy this? What defensibility do you have? So that opens you up. If you reframe the patent question into defensibility, then it allows you to talk about if you've got switching costs, or you can build a moat around your data, or because it's a network effect. So those are things to think about. And then finally, other ways to prove this value is the user engagement metrics. And then if you're more of a B2B product, the ROI. Have you actually shown that this saves time, or saves money, or increases revenues? So those are some of the things to look for. And I want to emphasize again the word enough, because I think that's a really important thing to think about. Traction, that's probably another word, right? Coachability, traction. As entrepreneurs, if you've been out pitching, you've been hearing that. So what are they looking for? I think a couple of things high level to keep in mind is when you're talking about your traction, your momentum, try to anchor it to your stage and the amount of money you've raised. Because, for example, often traction gets described in terms of number of customers or revenues, which is a good start. But I would argue that, hey, a company that has generated 500K of revenue and has only raised 500,000 might be more attractive than a company that has 2 million of revenue having raised 5 million. So therefore, that starts getting into a capital efficiency metric, assuming that the company's technologies, business models are similar. And so I think that gets into quantity or quality. It's not just enough to sort of say, hey, we have this many customers or revenue. There's a quality metric, right? Whether it's engagement, usage, or retention, if it's a subscription model. And then even the traction, especially if it's early with a handful of customers, you'll often get asked, how did you get those customers? Because the investor's trying to understand, did you get those because of your network, which I don't want to discount, those are still valuable, but it doesn't necessarily suggest repeatability yet. So a lot of times we would ask, hey, how did you get those customers? And then really kind of just general growth rate engagement. I think often and even on our side from an investment standpoint, we probably need to focus on this more, is like not just what's their ARR or revenue level, but how quickly did they get there? What's the growth rate? Because that is a big indicator for the momentum of a company, and really will drive valuations. When you start getting into priced rounds, the multiples are also based on how fast you're growing. I think we've already talked a little bit about that, but repeatable customer acquisition. If you're on the earlier stages, investors shouldn't expect see that you've got it all figured out. They may still ask you about it to figure out where you are in that process, but hopefully you are testing different models of customer acquisition, and you can speak to it like, hey, we're testing these couple of ways. And these are some early results we have. You're not quite ready yet to declare here's your CAC, customer acquisition costs, or LTV, lifetime value, but any directional indicators are very valuable, because ultimately, when you're raising a price seed round or maybe a growth round, those investors are really going to want to feel that you've figured out that sort of growth engine of how to get customers repeatedly so that their investment could help scale. But I think even in the earlier stages, they are going to ask about that. I think we're nearing last couple slides here. These are around kind of the financials. I think first is the financial economics. And really, this is a function of many factors, right? It's your industry that you're going after. It's your business model. Often you'll hear the term unit economics. So wanting to understand on any individual transaction, how are you doing? Is it profitable for you? If you're a hardware product, definitely gross margins, cost of goods sold, and then of course, recurring revenues. And this is an important factor. And I still haven't figured out how to easily explain it, but this may often drive a lot of the variability you might see between why one company seemingly can raise a pretty large price round based off just having a handful of customers, and another company may have to show a lot of traction. So I think a lot of times when we're looking at that, it starts, kind of coming back to some of these things. For example, marketplace models are really hard models because they're, you have to build two sides of the marketplace. The unit economics may be challenging. You might sometimes have to do a revenue share with one side of the market. It's not recurring. So I use that as an example for why maybe a company that's going after a marketplace model investors may require to see, I don't know, several $1 million of gross merchandise value, or more revenue traction than another company that might be a B2B, where it's a SaaS model. And honestly, if you could sell 3 or 4, prove out that you can get $1,000 a month or whatever price point you have, that would be attractive. And then I think the second part of this is the funding plan. I think we almost always ask these questions in the pitch, and I've described it, it's almost like a Mad Lib. So in some ways, the Mad Lib is, I am raising X dollars to achieve Y goals in X months, or I have so much runway, so that at the end of that period, I can raise, it's usually raise that next round, or we get the break even, or get to an acquisition if you're a later stage company. So in some ways, and I think the main thing is, often we'll see the use of funds slide, the pie chart saying we're spending this much on development, this much on marketing, which is a good start. But again, think about the goals. It's even better, say, so that we can get to this level of traction. We build out the product. We've proven out some of our distribution channels. We're getting to a 10K monthly run rate, so that we're then well positioned to raise that price seed round. So that's really sort of the cadence or flow that we're looking for in terms of kind of the fundraising plan. Now, a key part to developing that plan is understanding the current market of what investors are looking for at various stages. And even that, even if you can get a pretty accurate read, it's still going to vary by your company and how a given investor views your business model, or even just their inherent gravitation to what you're doing. But I think, at least having some general ideas that, hey, that investors are looking for, $1 million, revenue run rate to be able to raise a Series A round, or maybe a large seed round, because those are things that are important to know, and understanding it for, again, your industry, your type of technology and business model. I think one thing, even though I showed this chart by next view here, where this was a few years old, so that's another caveat. Definitely, be aware of the time frame, because that's changing. But they at least try to delineate by different types of business model, what do you need to achieve seed or Series A. And again, I would venture the actual numbers have changed, but I really like this as a way of breaking out, kind of milestones by model. The other one, Elizabeth Yin from Hustle Fund, highly recommend following her on Twitter, subscribing to her newsletter. I think her Twitter handle is like DunkHippo33, but I love reading her stuff. I mean, whenever she does a tweet storm, I find myself nodding, and I read it a lot to make sure I'm staying current, as well as what are some of the trends, and also what you as founders are seeing out in the market, especially if you're engaging with someone from the West Coast. So really kind of final thoughts. I think every investor is different, which makes this challenging because if you think about all the variables I just laid out there, and the fact that for every given investor, how they weight things, how they look at it might actually vary, that makes it a tough process. While I went through a checklist, a lot of, sort of individual slides, I really don't want you to think of it as a checklist, or think of the hat rack analogy, right? Weight the components accordingly. What are the strongest part of your story? What are the things in your story that investors usually ask you about the most, or have the most questions about? Because that probably also gives you an indicator how they're evaluating your business. So you have to think about that. I saw a presentation the other day where it took about 15 minutes and 12 slides before they got into the fact that they had $1 million+ in revenues. And so I mean, I use that as an extreme example. It's like, wow. I mean, I was trying to figure out during the first part of the presentation, all right, where are they? Or, is this pre-product? Is this, post-product? And then, kind of about 20 minutes in, I saw they shared the revenues. I wanted to yell, hey, put that up front. But really, the key is just to think about how to best tell your story. Whatever makes you most comfortable, how you think addresses your strongest points, and also probably addresses some of the key questions you get. And then finally, virtual. And I really think these points are applicable in real life setting as well, in person. But in virtual, especially now that everyone's hit Zoom fatigue, being crisp and concise is even more important. It's harder to engage your audience. And then I have this rule called the 1/3 rule with time management, that in these presentations, like you really plan on your presentation only taking about 1/3 of the allotted time. So you allow the remaining 2/3 for Q&A discussion, or honestly starting late, or folks having to leave early. And I think that can apply to a 15-minute office hours. If you're doing, mentor office hours, then really, you want to allow for at least 10 minutes of good discussion, or a presentation where you have 45 minutes or an hour. So that's just something to keep in mind. So that was kind of the slides I had presented. I've put my Twitter handle and my email here, and really would invite anyone watching this or to subscribe to the Innovation Works newsletter, or to any of our social media accounts. We're highlighting companies in our portfolio, events we're hosting, events in the ecosystem. And the Twitter handles for the accelerators are down below, no spaces in between. And then the Innovation Works Twitter handle is IWPGH. So thanks again for joining. And